Over the past year, it has become more difficult to generate profit and increase value to an investor's portfolio. Gone are the days of throwing magic darts at the stock page. How can an investor profit from the current market conditions or protect himself from a possible downturn in the market without much effort? I believe that if an investor looks into stock index options, they might find additional strategies to help them along their investment path. Let me ask you, is the market going up or is the market going down? Sometimes it's easier to predict where the market is not going to be going to in a given time frame compared to if it's going up or down from here. Is there a way to be wrong in the direction of the market and still be profitable? Using the advantage of time decay of options, it could be possible. The basic strategy of our program is to attain profits by selling options on the S&P Stock Index futures, balancing collection of premium with risk management. This is executed with the use of selling option spreads, with the objective that both options expire worthless and that all the premium collected from the sale is retained as profit. It is a way to take advantage of time decay in a limited risk strategy. Some of the benefits of using this type of program are that it can be used to possibly generate monthly income and can be used to offset losses in a stock portfolio, as well as support market risk management. But why use stock index options? Because stock indexes tend not to be as volatile as individual stocks, and the options on stock indexes such as the S&P 500 are very liquid, allowing for less slippage in pricing. Using stock index options and credit spreads, an investor could possibly generate monthly income as well as help offset losses in their stock portfolio. These strategies can be used for risk management and tailored to fit a bullish, bearish, or neutral market outlook. What is a credit spread, though? A credit spread consists of two options of the same type, two calls or two puts, and the same contract month expiration. You sell one option at a particular strike price, which you collect premium for, and you buy another cheaper option at the same time. This limits your risk on the option you sold. Because you're selling a more expensive premium option than the one you're buying, you're taking in a credit. Your risk is the difference between the two strike prices, less the net premium you collected, plus commission and fees for placing the trade. By placing the trade as a spread, you never expose yourself to unlimited risk. By selling out-of-the-money option spreads, the probability of profit is increased without increasing risk. There are basically 5 different scenarios that could happen in a particular market over a period of time. It could be bullish, slightly bullish, in a trading range, slightly bearish, or bearish. Let's consider the advantages of selling out-of-the-money credit spreads on a stock index like the S&P 500. For this example that we're going to discuss, we would sell a put spread below where the market is currently trading. The time to expiration of the option spread is going to be about 20 days for our example. If the market is bullish, slightly bullish, or in a trading range, the put spread would expire out of the money. If the market is slightly bearish but does not fall below the strike price that we sold on the credit spread, it too will expire worthless, allowing you to keep all the premium that was collected. Only if the market falls below the strike we sold, we will encounter risk of loss. That risk, though, is limited because of the put that we own. We have seen the major indexes slide from their mid-May highs to the current lows. The S&P 500 was trading around 1440 on May 19th to the recent low today, July 1st, 2008 of 1261. This is a drop of over 12% in the past 6 weeks. We are looking for a short-term bottom in the market. Although we might see a further slide, we feel that there will be a rise from the recent low. we believe that the S&P 500 will not drop more than 6% or below 1180 within the next 20 days. We recommend that selling the July 1180 put on the September S&P 500 index and buying the 1160 put to limit the risk on the trade. We would collect 2 points for the put spread, or $500 less commission and fees. Each point on the S&P is worth $250. Initial margin on the trade is less than $3,500. The maximum risk is the difference between the option sold and the option bought, which is 20 points. 1180 minus 1160 is 20. Less the points of collected premium, which is 2, which equals 18, times 250, which is $4,500, plus commission and fees. If the options expire worthless, your return on initial margin is 14%, less commission and fees, in 20 days. Return on risk is 10% in 20 days.